Hey there, this video is going to go through accounting for bad debts of a business. So let's start off with looking at what happens when a business makes a sale on account. They will increase their sales revenue. This is a credit. And they will increase the accounts receivable. This is a debit. Accounts receivable is an asset. The future benefit is that you will collect the cash soon. Most customers will pay the cash they owe. So when you collect the cash, you debit the cash to increase and you decrease or cancel the accounts receivable. But there are some customers who won't give you the money. You know, there are just some bad people who maybe they buy something and they don't plan to ever pay for it. Or you might have some customers who buy your products but then they just run out of money. Most businesses are unable to collect all of their accounts receivable. So if a business is unable to collect all of their accounts receivable, this is an expense, and the name of this expense is bad debt expense. Now, there are two methods to account for a bad debt expense. One is called the direct write-off method. In this method, you record the bad debt expense when you know that the money cannot be collected. So, for example, you sell a product to your customer on account and you ask them to pay you in 30 days. After 30 days, you still haven't got the money. So you call them up on your phone and you say, "Hey there, you owe me $5,000. Can you please pay?" And they say, Sure, I'll pay you soon." You go, "Okay." Another 30 days goes past and it's the same thing. You haven't got the money. So you call them up and they promise they're going to pay you straight away. And maybe this happens for a few more months. Then eventually you call them up and they say, "I'm so sorry. I've got no money, I can't pay you." This is when you know that you're not going to get the money from your customer, and then you record this as a bad debt expense. Your debit is for bad debt expense. This is increasing the expense, and the credit is for accounts receivable. You are decreasing your asset and cancelling that because now you know that you're not going to receive the cash. That is not an asset for you anymore. So the advantage of this method is that it is simple to use. However, it does not follow the matching principle. What that means is you might have recorded your sales revenue and accounts receivable maybe in March, but you only find out that you cannot get the money in September. That's when you record the expense. So in one financial year, you have the sales revenue, but in a different financial year, you have the expense. They're not matched together in the same financial year. So because of this reason, this method is not allowed under GAAP. Not every company has to follow GAAP, but if you're a large public company with shareholders, you do have to follow GAAP, so they cannot use this method. If you're just a small company with one owner, this would be fine. So large companies are required to use this method, the allowance method. So if you read the annual report for companies, it's likely that they'll be using this method. So the key word here is that we estimate the bad debt expense and record it at the end of each year. This is the journal entry to record the bad debt expense. This is like an adjusting entry that you would do every year. The debit is to bad debt expense, so you are increasing the expense. The credit is to something new. This is called the allowance for doubtful debts. This is a contra asset. To increase a contra asset, you do a credit and it has an ending balance on the credit side. Allowance for doubtful debts is a contra asset that goes with accounts receivable, and this will decrease your total accounts receivable. Now, the number that you put here for the debit and credit is going to be estimated. These are the two methods, and I'm going to show you how to do that in a few minutes. So this journal entry is to record the bad debt expense. Then you have another journal entry when you know that a specific customer cannot give you the money, the accounts receivable is cancelled or written off. So for the allowance method, to write off the bad debt, you will debit the allowance for doubtful debts. This is going to decrease the contra asset, and you will credit accounts receivable, and this will decrease the asset. The purpose of this journal entry is to cancel the accounts receivable. Because you know that you cannot collect the cash, then that accounts receivable is not a real asset for you anymore. There's no future benefit. You're not going to receive anything. So we need to cancel it. The number that you use here is the actual amount owed by that customer. Do you believe that miracles can happen? Very occasionally they do. So maybe the miracle might be that your customer told you they cannot give you the money, and then a few months later they actually ring you up and they say, hey, guess what? I've got some money. I'm going to give it to you. Wow, that is a miracle. We call that a recovery of a write-off. Now, to do this, you need to do two journal entries. This first journal entry here is flipping over the write-off. So we reverse the write-off, and when we do that, we're putting accounts receivable back as an asset. And then the second journal entry is I'll start again. So this journal entry here will increase the cash that you now receive from the customer, and then you decrease the accounts receivable. When you're using the allowance method, you need to calculate now the net accounts receivable. Net accounts receivable means how much you think or you estimate realistically that you will actually collect from your customers. So it's your accounts receivable asset, and then you minus the allowance for doubtful debts. So remember that this is a contra asset. Now, the advantage of this method is it does follow the matching principle. So you record your sales revenue, and every year you will record the bad debt expense, and it will match together in the same year. And it also follows this qualitative characteristic of prudence. And you might not remember talking about this. It's from chapter 1 of the financial accounting book. Prudence is about being conservative. Instead of showing the full amount of the accounts receivable on the balance sheet, we're actually going to show a lower amount, an amount we think we're going to collect. Prudence is about showing the worst case scenario. The best case scenario is that we would collect all of the accounts receivable. But the worst case is actually we're going to get less than that. And so that's what we want to show on the balance sheet. The disadvantage of this method, as you may have noticed, it does require estimates. So I'm now going to do an example with you for each method. So the first one is the direct write-off method, and we're going to record the journal entries for Sammy's sales. So first one is 21 October. Sammy makes a sale on account. So accounts receivable is increasing. This is a debit. And we have sales revenue increasing. And this is a credit. So this is the normal journal entry that you already know how to do. Now, on the 12th of July, Sammy determines that he will be unable to collect $1,000 from his customer. Now remember, the method is quite important. This is the direct write-off method. So on the 12th of July, we need to cancel the accounts receivable. So that would be a credit. The amount is for $1,000. The debit, why are we cancelling the accounts receivable? Determines means knows or finds out that we are unable to collect the money. This is a bad debt expense for the business. 1,000. Okay, moving along, let's take a look at the allowance method example. So question 1, credit sales for the year. We have accounts receivable increasing, and we have sales revenue. Okay, number 2. Let's have a look. Duncan estimates, based on past experience, that $8,000 of these sales will not be collected. So our keywords here are estimates. The journal entry when you estimate bad debt expense is you will debit bad debt expense, and we have $8,000 here, and you will credit the allowance for doubtful debts, also $8,000. This journal entry will increase your expense and also increase your contra asset. Number 3, Duncan determines a $2,500 receivable from 2015 is uncollectible and decides to write it off the books. So determines means he knows or finds out that he cannot collect the cash from his customer. So this is the journal entry to write off the actual accounts receivable. For this journal entry, your debit is the allowance. I'll copy and paste that. And your credit is the accounts receivable. When you do this, you are cancelling the accounts receivable and you're also decreasing the allowance. The number here will always be the actual amount that the customer owed to you. Okay, number 4. A customer whose account is already written off pays his bill. This is what we called a recovery. It's a miracle. You need to do 2 journals for this. The first journal is to flip over the write-off journal. Why do we need to do that? So I'm flipping this over, I'm swapping the debits and the credits. What I need to do is put accounts receivable back into the asset. I have already cancelled and deleted that accounts receivable, so now I want to put this back into asset. So accounts receivable is increasing, and I use the allowance to do that. My next journal entry is to then collect the cash from the accounts receivable for the same number. Okay, so I have some practice questions for you to do. Lecture exercise 1 and lecture exercise 2. So the first thing is for you to read the question and then write down here which method. So when I say which method, I mean, is it the direct write-off method or is it the allowance method? Once you've done that, then I want you to fill the table in with the journal entries for both of these questions. Can you stop the video now and fill that in, please? So the first method is the direct write-off method. First, you need to record the sales on account, and then it says they know or find out that they cannot collect the cash. So then you need to write off the accounts receivable. So you decrease the accounts receivable and you show that this is an expense for the business. The second method is the allowance method. So we have credit sales first. In number 2, it has this keyword here, estimates. So that means this is your journal entry to record bad debt expense. That's your debit and credit. Your expense increases and you also increase your allowance. In number 3, this is the journal entry to write off a specific accounts receivable. You're cancelling or decreasing the accounts receivable. So you might be wondering about this $5,000. How do you estimate the bad debt expense? That's the next thing I'm going to show you here. So remember that you only estimate bad debt expense when you're using the allowance method. And there's actually 2 ways to estimate, and both of these will use the past experience of the business. So method number 1 is called the percentage of sales approach. So to calculate your bad debt expense, you get your sales and you multiply by the percentage of sales that are bad debts. So for example, we have $250,000 of sales and we estimate 4% we will not collect. So you get your sales number and you times it by 4%. And can you calculate that number for me? All right, did you get $10,000? And that goes into your debit for your bad debt expense journal entry. Where does this 4% come from? You take a look at what has happened in the past for your business and you estimate this percentage based on your past experience. So advantages, simple, it's good at matching the expense to the revenue. The disadvantage, it doesn't consider the allowance for doubtful debts. So this brings us to the second method, which is a little bit more complicated. Now the focus of this method is on the accounts receivable. And to do this, there are 2 steps. Number 1 is first you calculate the correct balance for the allowance for doubtful debts. That's the accounts receivable times your percentage estimate. And step 2 is then to adjust the allowance account. So here is our example. A company has a receivable balance of $24,000. Based on past experience, they expect that 2% is uncollectible. So step 1 is to calculate the correct balance for the allowance for doubtful debts. To do this, it's the accounts receivable times the percentage, and this gives me 480. Now this will be a credit balance for the allowance for doubtful debts because it is a contra asset. All right, so I've opened the T account for allowance for doubtful debts. So remember that this is a contra asset. So the ending balance for any contra asset is going to be on the credit side. The credit side is the increase side and the debit side is the decrease side. Okay, so this 480 that we have here is what we have actually calculated is the ending balance for the allowance for doubtful debts. Have a think about why. What we've calculated is this is your accounts receivable and we've said 2% of this we estimate that we cannot get. That's our allowance for doubtful debts, which shows us how much of the accounts receivable we cannot collect. Now in the question, it tells you that the allowance for doubtful debts there's already a $100 credit balance here. So what we need to work out is what is this number here? 100 plus something equals 480. What is the something? The something is 380. This is the number that we're going to use for our journal entry. I need to credit allowance for doubtful debts, 380, and this will add 380 to my account, which will give me the correct ending balance. The debit has to be the same number, and that's to the bad debt expense. So take a look at this second situation. What if the allowance had a $50 debit balance instead? So I've demonstrated that here. The 50 is on the debit. We've still got this same balance. What number has to go here? This number minus 50 equals 480. So to get this number, I'm going to add these two together and I'm going to get 530. So can you check? 530 minus 50 equals 480. The same debit and credit, and we put our 530 number in here. So this method focuses on the accounts receivable. So it's going to give a more realistic net realizable value for accounts receivable, but it doesn't match the expenses as well. Okay, so still thinking about the accounts receivable method, there's something else we can do to get more detailed information. So do you remember up here, how did we get 480? We had the accounts receivable and we multiplied by 2%. So what I can do is split the accounts receivable up into different ages. And what I mean by that is we can split it up based on how long we have been waiting. And then the longer we have been waiting, we can use a higher percentage. Because you know, the longer you wait, then the less chance there is that you will ever get that money. So have a look at this table here, and you can see in this example that this number is the total accounts receivable, and it's split into all these different columns. And the columns are the number of days past due. In other words, how long have you been waiting to get that money? And here you can see the details. What's the different customers' names and so on. And you add that up and you get these total amounts. Then you can apply a different percentage for each category. So for example, if it's not overdue, there's a very low percentage of being a bad debt. But if you've been waiting over 90 days, you have a very high percentage that you won't get it. So you get the accounts receivable number times the percentage, and you get this number here, and you do that in each column, and then you add them all up. So you add all this up, and it will give you this number here. So this number is your allowance for doubtful debts balance. So I have now updated the T account over here. I've put in the ending balance. In the question it says the allowance already has a credit balance of 870. So we need to work out what number to put in the journal entry. So it's your ending balance minus the beginning balance, and we get this number here. So that is the number that I'm going to put down here into my journal. And this is the journal entry to estimate the bad debt expense. Here is some lecture exercises. I'd like you to stop the video and please complete all of those lecture exercises. So in the first lecture exercise, we have sales on credit. Then question 2 is to record the journal entry for the bad debt expense. 1.5% of credit sales, so use the 4,000 up here. And to record bad debt expense, you increase the expense and increase the allowance. And then question 3, you need to write off and you use the number that's given. This is the journal entry when you know you cannot collect the cash from the customer, and so you cancel the accounts receivable. All right, taking a look at question 2, you will need to make a T account for this one. And we have a receivable balance of 15,000 and we estimate 2% is uncollectible. So 15,000 times 2%, and you're going to get this ending balance for the allowance, it's 300. The existing balance is on the debit side and it's 200, so I put that here. So what number needs to go here to change the 200 on the debit to a 300 on the credit? You add those two numbers together. It's 500, and you can double check. 500 minus 200 equals 300. Okay, so in number 2, what if we cancel that? And what if we said that there was a 100 credit? What number would you need to put here? 100 plus something equals 300. The something is 200. All right, so please have a practice of those questions. Now, there might be something that you're thinking about at the moment, which might be, if we estimate bad debt expense, what does that mean about the numbers in the financial statements? So this is something I want you to start thinking over the next few weeks. Accounting is not maths. It's not adding up numbers and getting a profit. Accounting is trying to communicate how the business is going, and so we need to use different methods to communicate that in the best way we can. And sometimes that does involve estimating some information. But what this means is that the numbers are not mathematically accurate. There's not really just one answer. One person's estimate could be slightly different to someone else's estimate. Now, at the end of the day, we still want the accounting information to be a faithful representation, to be an authentic picture of the business. And sometimes we can have some unethical accountants who might use this to their advantage. And so they might change the expense or change the estimate to achieve maybe a higher or a lower profit depending on their motives. So this is something that you need to start exploring with accounting. It's that it's not just maths, it's not just adding up numbers. We're trying to think about how best to communicate this business situation to a range of users, and so sometimes that does require estimates to be used.